I would like to welcome everyone tonight to our 1099R training. Wanted to go ahead and give you a quick overview of some common questions we've been getting over the past year, give you a little preview as to what the filing season for 2019 returns will look like, and go over a couple of commonly asked questions just to be sure everyone's on pretty much the same page with how we want to deal with things within VITA scope here for the 1099Rs. Big area we have, a lot of retirees in this area, not surprisingly, given the amount of retirement communities we have in Lancaster County. So 1099Rs are going to be a pretty popular source document for us to work with, and does involve a number of questions that arise. So just want to kind of go through what normally is reported on 1099R. Those are going to be areas coming out of the IRA distributions, simplified, the SEPs, the Simples, which are Savings Incentive Match Program for employees, pensions, annuities, and then certain insurance contracts. All can be reported under the 1099R. A couple questions we get into, and we do actually have in your handout kind of almost a frequently asked question. And one of the questions people may have is, what's the difference between a pension and an annuity? Or what are the differences between an IRA and a non-IRA type annuity? In the past, we've actually had two separate lines on the 1040, one for ones that actually had a IRA, SEP simple box check, and the other one was where our pensions would go. The reason we had those separately is the IRA, the SEPs and simples are actually an employee-controlled investment program. So if you have your own IRA, you can actually choose where you have it hosted, who the provider will be, you have control over your investments. The pensions and annuities are actually an employer-sponsored plan. Generally your 401ks, your 403bs, or an annuity coming through a third-party provider, which may not be as controlled as much by an employee. They're taxed entirely the same way, with a couple of exceptions when we get to some of the rules about early distributions. And then there is a difference between a pension plan and an IRA. So we'll talk about a few of those once we get to the exceptions to the early withdrawal penalty and a few other items as well. But basically what we're taking a look at are what would be the box information on the 1099Rs. This is really kind of your critical element to determine taxability, what type of account we're looking at, and how do we help determine where this should be going on the individual return. Now, we do have a couple examples for you in your handout. These are a little bit more along the lines of our kind of unique items. But one of the things we can see on your very top sheet here, which is a MetLife annuity, we can just take a look and see that in box 1 is the gross amount of distributions. If we're lucky, there will actually be an amount in box 2A, which is taxable amount. We'll talk about what to do if there is nothing in the taxable amount box, which happens quite frequently. The other things we'll see are box 2B. Those are directly underneath there, which can indicate either the taxable amount's not determined, which usually means that area of 2A is blank, and also to watch out for 2B where it says total distribution. That's generally when someone has withdrawn all of the funds from their account. That could indicate that we have either a lump sum or a premature distribution from the account. That's typically going to give us an indication there. The next one to always watch for is box 4, which is going to be your federal income tax withheld. A very important box, particularly if people are in a taxable income situation. If we see an early withdrawal from a retirement plan, hopefully someone has taxes withheld in box 4. If not, it's going to be a couple extra tissues that they need by the end of the appointment. So we'll talk a little bit more about what the early withdrawal provisions look like, but just bear in mind those will have some consequence. Box 5 will oftentimes have some information in there. Typically what that's going to show is the amount that's recovered tax-free for the current year. So sometimes you'll see that when we have an annuity, we may have some sort of pension program that the employer has determined how much is taxable and how much is not taxable. That can usually help describe the difference between a box 1 and a box 2A, the difference between a gross and taxable amount of distribution. Typically, other than that, box 5 is just for information purposes. We really don't do much with box 5. But every so often you may see an amount in there, and that generally is going to show the amount of tax-free funds received by the taxpayer for the current year. Box 7 is probably our most important box, other than obviously the amount of distribution. That's going to give us an indication of how this distribution should be treated, not just for federal purposes, but also for state and local as well. So the codes that we're going to see in box 7 are going to go through and allow us to determine how that's going to be treated within the tax layer program. The fortunate part is if we put the codes in, it should automatically flow through on the other parts. The exception being It will not always do the 7Ds appropriately. So we'll talk a little bit about how that'll work for Pennsylvania. Box 9B, a little bit further down, is actually a box that would show total investments in lifetime annuity under a qualified plan or after-tax contributions to a 403B plan. This will help us indicate how we would use the simplified method. If we are taking a look at a distribution from a qualified plan in the first year of distribution, this information will generally help us understand how much is the employee's contribution made on an after-tax basis. Essentially, what can they recover tax-free? So generally, the 9B information will be used when we talk about the simplified method a little bit later on. Box 12 is going to indicate state tax withheld. Generally, we should not have any for PA, mainly because PA doesn't tax retirement distributions made under the normal retirement program. Every once in a while, we may see one if someone has an early withdrawal from a retirement plan that they may have some state taxes withheld. Generally, that's not the case. It's so not the case that Pennsylvania wants to see a copy of the 1099-R if there is any state tax withheld, because they just don't believe anyone should ever have taxes withheld. So I don't want anyone to just overlook and say there's nothing beyond box 9 we need to look at. You do want to double check it and make sure there's nothing in box 12. We sometimes see these with out-of-state third-party administrators that may try and withhold state taxes. It is not necessary for PA, but if they do have something there in box 12, enter it and it will flow over to the PA 40. All right, so as we talk about box 7, a couple of the codes that we want to take a look at. The first one is the worst one. We're going to start with the worst and then work our way down to some better codes down here. One, when you get that one, generally, like we said, is probably going to have that total distribution box checked in 2B. And then you look a little further down and you look across the table, and the person across from you does not appear to be 59 and a half or in any type of retirement state. If they've taken their distribution out early from their retirement plan, a code 1 will appear. It means that it's an early withdrawal from their retirement plan. There's no known exception by the third-party administrator. In most cases, the individual is under 59 and a half. And I think we're seeing a little bit more of these, or we have seen these over the past couple of years, particularly as people may have migrated from one employer to another. Oftentimes the situation arises as you separate from service, as you go through your HR final analysis. They say, oh, by the way, you have a couple $1,000s sitting in a retirement account. Your options are, 1, you can roll it over to your new employer plan if they allow you to participate immediately. 2, you can roll it over to your own retirement account, such as an IRA. Or 3, you can take the cash immediately. Most people forget the first 2 options once they hear option 3, that I can take the cash right away. Generally, the third-party administrator will let them know and also have a mandatory withholding of 20%. So if an employee has a box 7 code 1 and 0 in the federal tax withheld, they told the third-party administrator, I'm good, don't withhold any taxes. That's not the same story they usually have when they come in, because they say, one, we're going to see some federal implications. We're also going to see implications under a state and local level as well. Got information from Steve that we're seeing a lot more code 2s coming through. These are early withdrawals from a retirement account, but the third-party administrator knows that there is an exception to the 10% penalty. So they're not going to go ahead and the tax system will not add the 10% penalty on to the early withdrawal. It's going to go ahead and add the taxable income in, but it won't assess the additional 10% penalty. The primary purpose of the penalty is to encourage people to save for retirement purposes. So because of the tax advantage nature of the retirement funds, if you take it out early, not only is all the income taxable, but it's also going to be subject to the 10% penalty. Code 2 basically means they meet one of the conditions set forth by the third-party administrator that the 10% penalty will not apply. However, it's always going to be taxable whenever you take money out of a qualified retirement plan. So it doesn't mean it's tax-free, it just means it's penalty-free. And also that means it's going to be taxable in the same state for Pennsylvania and for local as well. If they did not hit the minimum retirement age, Pennsylvania and local will consider that an early withdrawal from the plan, even though it's not subject to penalty. And that's one of the questions we have on your frequently asked handout as well. The Pennsylvania will treat code 1 and code 2 as an early distribution unless the participant has met the qualification for retirement from their company. Some companies will allow an early retirement before the age of 59 and a half. If that's the case, then it will not be subject to an early taxation penalty for Pennsylvania. It will not be included in income. And we'll talk a little bit more about Pennsylvania as well. Disability at Code 3, we don't see that all that often, but a disability, again, would be a non-penalty type situation. It's the same thing with a death distribution with a Code 4. Code 4 will not be taxable to Pennsylvania. So even if you're under 59 and a half, that's not taxable to Pennsylvania. It's only going to be a 1 or a 2, or the D, which we'll talk about a little bit later as well, will be taxable to Pennsylvania. The one that we're hopefully going to see is a Code 7. It's a normal distribution that you're taking your money out of your retirement plan after the age of retirement. You're taking that over a series of periodic payments, and it is just simply going to be taxable for federal purposes, whatever we show as taxable income, but will not be taxed for local or state purposes, as long as you meet the minimum retirement qualification. Code G is if someone did take option 2 when they separated from service, and you roll your account directly from one provider into another one. You have not even touched the money. It's just moved from one provider to another. They still need to report the fact the money's no longer with them, but that's going to be a Code G in box 7. So that's just going to go ahead and automatically trigger no taxation. It's going to show as gross amount, but it's going to have a rollover connotation next to it, so it will not be subject to tax. An H is a direct rollover of a Roth account. So we may see people now, the Roth accounts are a lot more popular. So if you're moving your Roth account between different providers, we'll have a Code H. A Code Q is a qualified distribution from a Roth. Generally, again, that will be tax-free. And Code T is a Roth IRA distribution, but there's no penalty exception again, much like a Code 2. So again, that would not be considered a penalty opportunity for the government. We take a look and typically we'll go whatever the 1099-R says is taxable income. We'll kind of talk through that a little bit. Again, kind of the differentiation between the traditional IRA, SEP, and Simple. These are basically controlled by the employee. They can have a little bit more direction control over where their investments are. They can change providers relatively easily. And that's actually marked with a box right next to box 7, just to show it's an IRA, SEP, or Simple. In prior years, this was reported on a separate line. There have been some discussions we may see with the new finalized version of the 2019 that they may put it back to 2 lines. We'll see what happens with the government. Apparently their postcard filing has not gone quite as smoothly as I thought. For some strange reason, for those of you who have been preparing for a while, there's a ton of schedules that go behind it. So I don't know how you do that. You send a postcard with a staple piece of paper if you're filing manually with a bunch of attachments. But we may see some more lines showing back up again. But again, the main difference is just indicating what type of account that is. When we take a look at this, for the most part, whatever you show as a gross distribution will also be the same amount as your taxable distribution. So one of the things we'll take a look at is how do we determine how much should be reported on the individual return. So we take a look at box 1. If box 2 is blank and box 2B is checked, taxable amount not determined, we'll go through and ask a series of questions for our client. Mostly they will not know what the answer is, and you'll get a blank look back, and that's fine because we can work with the blank look. The other thing we'll take a look at is a Roth IRA. Roth IRAs, again, they'll show any taxable amount of distribution in box 2A. Hopefully the provider knows exactly how much is taxable. The traditional benefit with a Roth IRA is that you don't get a deduction for money's going in, but you don't pay taxes and money's come back out. So one clear distinction between a Roth account and a traditional retirement account. If we do need to make some modifications, hopefully we don't need to. This gets really complex with trying to override someone else's 1099-R. If you think that there's a mistake, the best thing to do is to contact the third-party administrator and see if they're willing to make the change. Sometimes they are, sometimes they can't, and sometimes they have no idea what you're talking about. But we have a little bit more difficult time trying to convince the government that the 1099-R is incorrect, and there are some mechanical forms we can go through, but it's a lot more difficult to try and correct a 1099-R that was submitted erroneously. But kind of getting back to that position about what happens when box 2A doesn't show any taxable income. And oftentimes this may happen because someone may have transferred their account from one third-party administrator to another, and the third-party administrator that now has the account doesn't know if there's any tax, after-tax contributions to that plan. So to be on the safe side, they say, we don't know if any of this is considered tax-free. So they'll just say, we don't know the taxable amount. Well, this is where we get to the question of our client. So the first question you're going to ask is, did you make any after-tax contributions to your employer-sponsored plan or to your IRA? And The look is basically what I'm getting right now. It's like, what in the world are you talking about? Which is a good thing, which means they probably didn't do it. If they didn't do it, if they don't recall that they made a non-deductible IRA contribution, which should be indicated if they have a prior year return, the 8606 should show their non-deductible IRA contributions from prior years. If they don't recall they've ever made an after-tax contribution to their employer plan, which generally doesn't happen, then we're in good shape. We're going to default that box 1 is the same thing as taxable income. And good news, TaxSlayer normally goes and treats it that way. Unless you tell it otherwise, it's going to assume box 1 is the same amount as taxable. Now, if there's a different amount in box 2A, by all means, make sure that that amount's sitting in your entry for TaxSlayer. And there can be a variety of reasons why that happens. If they come back and say, oh no, I did put some after-tax contributions in, either into my non-deductible IRA contributions, or my employer said, I can take some money out of my own pocket and put it in my 401k, which sounds like a great idea. At that point, we're going to very politely gather all the documents back, slide them across to the taxpayer, and wish them luck as they try and figure out how much is taxable and not taxable. It's a very detailed computation, something we just can't handle within VITA, and unfortunately, most of their third-party administrators have already told you they can't figure it out either. So we're not going to be able to do that calculation either. So if there is an amount that says taxable amount not determined, and they're telling you that they have some after-tax contributions, it's a lot more complex than what we can handle within our VITA structure. So hopefully they're well aware that that is beyond our scope. Now, when we take a look at Roth accounts, the nice part about a Roth account is the ability to put money in. You do not get a deduction for the amounts going into the Roth account. But if you meet the holding requirements, all the monies you pull out of the Roth account are going to be tax-free. And as long as you meet the following criteria, it's going to be actually an and statement. So you have to be 5 years after the first contribution was made, and you have to meet one of the following conditions. Either you're age 59 and a half, is due to a disability, it is received by a beneficiary of an estate, or if you have first-time homebuyer costs. Those are our 4 conditions. But the process starts 5 years after that initial contribution was made. If that's the case, neither the original contribution nor the earnings will be subject to tax. The best news is your original contributions are never subject to tax anyway. You never got a deduction for it, so you can pull those out at any time without a tax consequence. As long as you maintain the same third-party administrator for your Roth, they should know exactly how much you put in. So in most cases, the Roth 1099-R should be indicating how much is taxable and how much would be basically a return of capital. Again, that might be something we'd see in box 5. If we don't meet those 2 tests, if they're not in for 5 years, or they haven't met the age 59 and a half, first-time homebuyer, disability, or death, then again, we may run in that situation where it may become partly taxable. And again, unfortunately, we cannot handle that within the VITA program. Couple other things that we take a look at. The penalties would apply if you have an early withdrawal from a Roth IRA. Same thing with a regular IRA or 401k. We can use the form 5329, which we'll talk about a little bit later in the session, but very similar provisions apply to the Roth account. So if someone takes money out of a Roth account early, normally the IRS will try and impose a penalty. That penalty is a fairly onerous one, again, 10% on an early withdrawal from a Roth account on the earnings, as well as that amount being included in taxable income. But if you meet certain restrictions, such as higher education costs is a valid exemption to the penalty. So you can go through the form 5329 if someone comes in and says, I had to take money out of my Roth account, I used it to pay for college education. And we'll kind of talk about that dialogue you should have with your client as to exactly why the funds came out or how those funds were used. Other things would apply as well, paying medical insurance premiums if you've lost your job. If you have excess medical costs that are greater than the allowed amount for itemized deductions, those would all be considered viable exceptions to the penalty as well. So just want to give you a little bit more information on kind of the IRA structure. Those are the ones that are basically self-managed accounts. That could be either a traditional IRA or a Roth account. Now, when we talk about the pensions and annuities, these are traditionally going to be employer-sponsored plans, things that are coming out of a 401k, 403b, 457b if it's a government-sponsored plan. Just to give you an indication, they're all relatively similar type plans. 401k is generally a private sector employer. 403b is generally coming out of a nonprofit employer, and a 457b is coming out of a government-sponsored employer. So they're all relatively similar concepts in design. These will always be taxable in full to recipients unless they made after-tax contributions. When we take a look at the simplified method in a little bit, it's generally going to be some of our 403b and 457b participants that have made after-tax contributions to increase their pension amount. And we'll talk about the information, how we can get there. One other important part to realize, if someone is a retired public safety officer, and what we mean by public safety officer is a law enforcement officer, a firefighter, even a chaplain, or a member of a rescue squad or ambulance crew, they are entitled to have a up to $3,000 reduction of taxable income. Now, the criteria is that their pension is going directly to pay for medical insurance. So if they're opting into a supplemental insurance plan or it's part of their retirement package, they can deduct the they can either deduct the actual amount of medical insurance premium paid or $3,000. So up to $3,000 is the max they can take. But if they have $1,800 of medical insurance premiums that are withheld from their retirement distribution, they can take an $1,800 deduction. If it was $3,800, they can take a $3,000 deduction. So they can take a deduction for any medical insurance premiums paid directly from their pension account. So these might be things you may see from a supplemental statement. Oftentimes they are aware of this program. It's actually quite popular to be discussed among the volunteer firemen that have retired. So they know that they're entitled to this benefit. And TaxSlayer actually does a pretty nice job of doing the calculation as well. We'll enter PSO and it should show up on the 1040 itself. Partly taxable annuities, we may see these again. There may be a difference between how much is a gross distribution and how much they may actually have an investment in contract. So again, we may see an amount different on 2B than on line 1. And we'll see this a little bit more from this context. Annuities are kind of popular from this environment because people may have an investment in contract that they're getting returned to them tax-free. So generally pensions and annuities, we may see a slight difference between taxable and gross distribution a little bit more. What we can also take a look at is if there is a recovery amount, we can either take a look at using either a basically a simplified method, or we can take a look at a general rule. General rule is a little bit more complex, but we'll give you some information. Unique characteristics about them. Out of curiosity, how many of you have seen a 7D pop up? Okay. We'll let you know how to handle those. Those are a little bit unique because I don't believe TaxSlayer automatically knows what to do with the 7Ds. The 7's nice, it's normal, right? But the D part throws them off. They don't know what to do with the D. Well, the D is basically indicating that it is a non-retirement annuity contract. So rather than have an annuity from your employer, whether it's a pension type arrangement or annuity type arrangement, you can actually purchase your own private annuity. It's basically an investment product. So what a non-retirement annuity is a series of payments made over someone's life or a period of years. What that's going to represent is part of it is their own money coming back to them, their original investment, and also earnings. So Pennsylvania says, well, we don't tax retirement income, but a non-retirement annuity is not retirement income. It's actually an investment income. So the 7D is going to indicate for Pennsylvania purposes, that should be reported as interest income on the PA40. Not subject to tax for local, but it will be subject to tax for Pennsylvania. So if you see a D on a 1099-R in that box 7, that's going to indicate it's taxable for Pennsylvania purposes. Same thing if you see a distribution code F. We may not see that all that often here within VITA, but that would be a charitable gift annuity. Sometimes as people are entering a retirement community, particularly one that is a nonprofit, they may be donating some funds to a annuity product. It's basically a charitable gift annuity. So basically, they'll get a series of payments. At the end of those payments, the balance will revert back to the charity. It's kind of a nice way of making a donation. But those also are non-retirement annuities. So if you see a code F in a 1099-R, it's going to represent, again, interest income for Pennsylvania purposes. Distribution code 4 is going to represent someone who has received money as a beneficiary. Code 4 is not taxable for Pennsylvania. It's also not taxable for local as well. There's no early distribution penalty, so taxpayer should know not to apply any additional penalties to a code 4, even though the taxpayer is probably under 59.5, or maybe. So that just gives you an opportunity there. Taxpayer believes you're doing a pretty nice job of a code 4, should not go anywhere else. Again, with anything else on 1099-R, the gross distribution may be subject to tax. The taxable amount will always be subject to federal income tax. Okay, so what do we have when we get into that partially taxable pension and annuity? So there are a couple programs. Again, the majority that I've seen in the past have been governmental employees who may have put some after-tax dollars into their pension account, effectively to help go ahead and boost their retirement payout. So if you do have an investment in the contract, basically what we're going to take a look at are any things that you may have paid after the fact, any contributions, any premium paid with after-tax dollars. So this is where we're going to see the after-tax dollar element come in. Typically, those are going to be shown on line 9B, again, in the first year that the distributions have started. So 9B is going to indicate the total investment in the contract. Once we see that, then we may be able to go on to the simplified method. And the simplified method is basically allowing you to take that investment in contract and reduce the amount of taxable distribution over a series of years based on a couple tables. We'll actually walk through an example here tonight. So what we want to take a look at is the simplified method can be used. The first condition shouldn't be too difficult. Annuity started after July 1st, 1986. So we're well past 1986 at this point. So I don't think we have any confusion there. The first part should be good. If anyone has been using the simplified method in a prior year, we should continue using that same amount each and every year to reduce their taxable amount. Usually we'll find this if someone brings in their prior year return, if it's their first year with VITA. It's critically important we take a look at their prior year return. If they've been using a simplified method, we're going to continue to use that same amount. We just have to watch we don't continue to take it beyond the time frame in which it expires. So we want to be sure we kind of enter it back in a tax layer, knowing how many years are still left on that calculation. So the other thing we take a look at is annuity started after November 16th, 1996. Again, should not be a problem. We're in 2019 now, and both the following apply. So we have to take a look first to see if the payments from a qualified employer plan, which it generally is, a qualified employee annuity or a tax sheltered annuity plan. Again, coming out of a 403B or some sort of nonprofit plan. And on the annuity starting date, either the annuitant was under age 75 or the number of guaranteed years is fewer than 5. So in most cases, I think what we're seeing is that these are retirement annuities. People reach retirement age, they're under the age 75, they're going to retire, take a series of payments, and that's what's going to trigger the opportunity for us to use the simplified method. Again, it'll be the first year distribution, and typically we'll see that amount reported in line 9B of how much their annuity in the contract would be. If you cannot use a simplified method, then we can actually use a general rule. It's a lot more complex. I'm not quite sure how often has anyone used the general rule within VITA? Okay, maybe a good thing. It's a relatively complex calculation. If we ever need to do it, most likely they're not leaving the day with their return. We want to take a look at that a little bit closer to make sure we do the calculation. Now I will say, oftentimes the publications are a little confusing to read. The publications for retirement distributions are actually not too bad. Publication 939 is actually the one we'd use for doing the general rule. Hopefully we don't have to do it very often, but in case we need to, it's a relatively nice reference source. Now, if we are eligible to do that simplified method, again, what we would need to take a look at, if they've been using the simplified method, we need to continue to use that. So if they have a prior year return, we should be looking at their prior 1040. If they are starting for the first year, we need to go and take a look at a number of things. We have to understand whether it's a single or joint life annuity. So generally they'll have that information to say, is that annuity over just their life? Or if they are married, is it over the spouse's life as well? We need to know the age of the recipient at the start date. So it's the age of the beneficiary and also of the recipient. So if it's a joint life, we need both ages. We also need to know the net investment in the contract. Again, that should be shown on line 9B of the 1099-R. So just a couple things we take a look at. What we do at this point is we'd actually refer to our tables for the simplified method. If it's a single life, we use table 1. If it's 2 people, we use table 2. So the IRS has done us a nice favor by actually helping the tables. So 1 person, it's table 1. Joint is table 2. So just count how many people you have and you know which table it's supposed to be at. I don't think they've gone to multiple spouses yet, so it's only joint life annuities. What we're going to use is we have to figure out how much their amount that they've received for the current year and take a look at the table. So we have just a quick example to kind of walk through here of the simplified method. And I believe in your handout of 1099 examples, we actually will have, if I'm not mistaken, a simplified worksheet on kind of the 4th or 5th page back there, kind of an opposite side. And this is the calculation that we would use. I believe, fortunately, it is located within TaxSlayer itself, so you don't have to get out the pen and paper and try and do it manually. It does have a worksheet link for you to be able to compute the simplified method. So what we'd be taking a look at here is Bill Smith, age 65, started taking retirement benefits in 2000. Well, we only have the 2018 table here, so we're going to use 2018. Start date is January 1st. Benefits are going to be paid over his life and also the joint life of his wife, Kathy, who is also age 65. Bill has $31,000 of qualified contributions to the plan, has received no distributions before the annuity starting date. He's going to be getting $1,200 a month. And then Kathy, once he passes away, will receive $600 a month for the balance of her life. So the first question we have, can we actually use the simplified method for this client? So we'll start with an easy question. It's either going to be a yes or no answer. And if you want to volunteer, I'll give you a second shot if you don't get it right the first time. I'll try and make it as easy as possible. All right, so yes, all right, wonderful. Yes, it falls in that qualification. So the annuity start date is after 1996, right? We are in 2018. We're well beyond 1996. The recipient is under the age of 75, so we're going to meet the qualifications. So what we're going to take a look at is because it is payable over the life of more than one person, we're going to go with table 2. So table 2 is how we're going to go through the calculation. Now, what we want to take a look at is line 1 is going to ask us how much we actually have received for the year. So if he's receiving $1,200 a month, we'll help you with those who didn't bring calculators tonight. You probably didn't realize there'd be a quiz. Well, $1,200 a month for 12 months is going to be $14,400. So that's going to be our amount that we're going to use for our total amount received for the year. Now, the next thing we take a look at is line 2 is going to ask us what is our cost in the plan or the contract at the annuity start date. Now, this is going to be the $31,000. Again, this should be coming off of line 9B of the 1099-R, or unless they have some additional documentation that shows what their investment in contract would be. Because we're going to go through and take a look at the appropriate table, our line 3 number is going to be calculated from the joint lives. Now again, 65 plus 65 is going to put us exactly at 130. So we go down to the table 2, take a look at the combined ages at the annuity starting date, which happens to be the 3rd line down, which means our divisor is going to be 310. Ironic how this worked out very well. $31,000 contract, 310. So we have $100 would be the amount on line 4. Now, the reason why we do this on a monthly breakdown is because what happens if this annuity didn't start until July? Well, we have to count the number of months that we actually receive payments. So this, for argument's sake, we're just using January 1st, so we'll do 12 months for both the amount received and also the exclusion. But what we're going to do is we're going to multiply that $100 by 12. So you'll see that would be on line 5. We don't have any amounts previously recovered tax-free. That would be actually subsequent years. We'd see that calculation go through in that aspect, which means that we won't take more than what we're supposed to take under the simplified method. So what that means is we have the $14,400 worth of distributions for the year. but we get a $1,200 exclusion under the simplified method. So the nice part is that he's only going to have to pay taxes on $13,200, not the whole $14,400. So the simplified methodology, once you use it in TaxSlayer, and again, it's going to go through the calculation. You don't have to manually pull out the worksheet and go through it. You just simply enter the same information and it will do the calculations for you. Again, what we're going to be seeing here is that it's going to be in the first year that the annuity has begun. If they are a new, or if they're a new client to VITA, it may be entering the information from the prior year forms, so we do the calculation correctly. So the first year that they get the distribution, we'll have to ask a couple additional questions. Was it a single or joint life? And most of the other information should be available directly on the 1099-R. Now, one of the questions arises, what happens if both of them pass away before the full 310 months? Well, technically, the remaining balance would be deductible as a Schedule A itemized deduction, which not many people qualify for itemized deductions anymore. So unfortunately, that may be lost if they both pass away. But if they both pass away, then they don't have to worry about income taxes anymore anyway. So it's really not, they unfortunately didn't recover anything as much of their plan as they wanted to. But if we do a final estate return and they do have enough to itemize, that can be a deduction that we take at that point in time. Okay, how many of you have done the simplified method before or have seen it before? Okay, how has it been in the system to work with? Has it been relatively straightforward? Okay, good, all right. It's always good to hear no major issues with the simplified method. And this is called the simplified method for a reason. This is much easier than doing our longer test if the simplified method doesn't apply. So simplified method, we can actually do it right in TaxSlayer and works out fairly nicely. Okay, so those are the ones where we actually can get some benefit by reducing the amount of taxable income reported on the 1040. The two primary ones we have are the investment in contract or by using that retired public service officer insurance deduction. The bad side, what happens with the early withdrawal from a retirement plan? Again, typically what's going to happen is you're going to first see that the box 2B is checked for a total distribution. And we're going to see a code 1 in box 7. They should probably call it code 911 because this really is kind of a tax emergency. This isn't a great situation for people to be in. So again, the federal treatment is automatically going to bring in whatever is taxable income. And again, generally line 1 is going to be the same as line 2A, is going to be taxable income in full. In addition, that amount is also subject to a 10% penalty. So if the client has taken $5,000 out of their retirement account, not only is it $5,000 in taxable income, but they already have a $500 tax bill before anything else happens because of that 10% penalty. Now, there are a couple exceptions to that 10% penalty, and we'll kind of go through a couple of those in just a few slides here. Normally, what will happen if you do the code 1, TaxSlayer is automatically going to do the 10% penalty, and you don't actually need to fill out the whole 5329. It kind of defaults to say if it's a code 1, they know the 10% penalty applies, unless we go in and tell TaxSlayer it doesn't. Now, the other thing we run into is Pennsylvania and local also consider an early distribution from a retirement plan as not qualifying as a retirement distribution. They consider that effectively additional wages. Now, what's unique about Pennsylvania, and local has to follow the same rules, is they're a cost recovery state, meaning that you can recover your cost of the amount that you put into your plan before you have to pay any taxes on it. Which gets us to the next question. What's my cost basis in my retirement accounts? Again, we get that same blank look to say, did you make any after-tax contribution to your retirement account? They have no idea. What's different about Pennsylvania over federal is that we don't allow a deduction for Pennsylvania for amounts contributed to a retirement plan. So if you have a W-2 and you see that there is a amount reduced for 401k elective deferrals or 403b elective deferrals, we'll see a difference in taxable wages for federal than we do for state. It's because they don't allow that same deferral. So one of the techniques we can use if this was an individual who had only been with the employer for a short period of time, one of the ways we can understand what their cost basis is to get copies of their W-2s. Whatever the amount of elective deferral was on those W-2s is the amount that they have invested in the contract. So if you pull the W-2s and it's hopefully only a year or two, and you can see what they have in those reductions, box 12, generally a code D or a code E, depending on how the plan was put in place. we can actually see how much their cost basis is. Now, if you ask them, how long have you been with the employer? Oh, since '83. That's a bit more of a unique issue that we have to deal with. At that point, we generally ask if they can go back and get more information from their employer. What we typically see, these early withdrawals from these plans are typically coming right out of a 401k plan, hopefully. If they've already left the job and converted to an IRA, and then they try and take the money out of the IRA, it's still going to show up as a early withdrawal. But at that point, guess what? It was self-directed. The third-party provider has no idea how much their investment in contract was. So again, it's a little bit of a unique ability for us to go back and try and recalculate. Again, the government will always help and give you a number to use for your investment in the contract, which would be 0. That's not a great number to use. But kind of our first technique is probably to go back and double check how much their W-2 contributions were for the past couple years. This is an area where they're actually getting a little bit more involved. You know, in the past, we just basically had a premise to say, why don't you tell me which number you think it is? I've seen a lot of notices now coming back from the Commonwealth of Pennsylvania saying, hey, we noticed that you put an amount down for cost basis for your early distribution from your retirement account. How about if you just send us that documentation that shows where you came up with that number? And it usually it's not going to be a hand sketch on the back of a napkin from your taxpayer saying, I think I put in $5,000 a year for 4 years, so that's 20 grand, right? So we should be good. They're actually looking for a little bit more documentation. Again, it goes back to the whole premise that we as providers and preparers of the return are actually using the information provided by the client. We can try and help them the best we can, but we shouldn't be the ones telling them what number to put down. So if there are any questions or concerns, we may have them want to talk to someone else, maybe go back to their employer if it was coming out of a 401k plan to say, can you help me? Do you have any idea what it is? Or have them do the research to pull their W-2s from the past couple of years. And if we can demonstrate what that number is, that's going to be great. Again, I just caution that because I've seen it in my practice where we're starting to get notification from the state, usually several months after the fact, which basically means it's going to be Steve and Michelle getting those notices when the client calls in August and say, hey, what happened? Why is the Department of Revenue sending me a letter here? Generally not a nice letter. They're basically asking for additional information. So again, as long as the client can help determine what that number is, and we may want to remind them that the state may be looking for that information. So if they say I had a total distribution in my accounts down to $5,000 because the market has been so poor over the past 18 months that I think I lost a ton of money in the account. Probably not the correct approach, right? So we want to take a look and make sure we have a correct number to use, at least get as close as possible. Again, we can't come up with a number for them. We have to basically have them help provide it with us. Now, all is not lost. There are some exceptions to the early withdrawal penalty. Kind of mentioned a few of these when we talked about the Roth IRA, some of the early withdrawal issues there. Anything that had been a distribution from an IRA that was converted to a Roth. So if you do a Roth IRA conversion, I'm not quite sure how many within VITA have done that, converted their traditional account to a Roth account. If you do a Roth conversion, all the proceeds are taxable in the year of conversion, but it's not subject to penalty. So generally that might be something we'd see in a box 7 code 2, knowing it's not an exception. There may be a rollover. So we talked about the direct rollover, that code G. You also have 60 days from the time that you take money out of your retirement account to put it yourself back into another account. That's a hard and fast 60 days. That doesn't mean I meant to be there in 60 days and the weather was bad, so I didn't get to the bank, so I got there on day 64. Well, if you're there day 64, this does not apply. It's taxable in full. But if you put money back into an account within 60 days, you can treat that portion that went back into a qualified plan as a rollover. And you can just go ahead and indicate that within TaxSlayer as a rollover contribution. Now, the downside is typically when people take money out of their retirement account, they also have tax withholding on it. So if you have taken $10,000 out of your account and they had 10% withholding, you actually got a check for $9,000. And if in 60 days you put that $9,000 back into another account, that's great. But you're still going to be taxed on $1,000 that they had withholding for taxes. So just keep that in mind. It has to be the full amount, or it can be a partial amount, but we may run into those situations. Again, it's a fairly strict kind of 60-day rule. Payment of IRS levies, if someone has back taxes and the IRS basically levies their retirement account. They tend not to like to do that, but if that's their only option, they will take money out of the retirement account. That's going to be an early withdrawal, but it's also going to be exempt from additional penalty, which kind of makes sense. If the IRS is taking your money to pay their taxes, they shouldn't penalize you on taking your own money to pay the taxes. Kind of becomes a revolving circle there. The other thing we see is the death of the original participant. So the beneficiaries can get a code 4, meaning that it's a inherited IRA or retirement, or we'd see a total and permanent disability of the participant. And we may need a Form 5329 if it's not indicated as a code 3. Generally, we're seeing these coming in as a disability distribution, but if they did not do it and they won't correct it, we may need to go ahead and indicate that on a Form 5329. If there are any exceptions, in TaxSlayer, you can actually have a drop-down menu here. You go into the early distributions not subject to the 10% penalty, and then you can select the reason and the amount for the exemption. So I just want to talk about a couple of the ones that are most common that we'll probably be seeing there. If we have an exception to the penalty, we're going to have to use the Form 5329. It does populate within TaxSlayer, and we can go through and use that to help offset. Again, it only will eliminate the penalty or a portion of it, not the total withdrawal. That's always going to be subject to federal income tax, and also subject to Pennsylvania local income tax up to the cost recovery. But some of the more popular ones that we'd see are going to be a code 5. It's qualified unreimbursed medical expenses paid during the year that exceed 7.5% of AGI. But that's only to the extent that they exceed 7.5% of AGI, which means they would have been able to itemize those medical expenses. Code 6 are areas where if the distribution's made under a qualified domestic relation order or a court order to a former spouse. Technically, the provider should have put that in as a code 2 if they had a qualified domestic relation order. However, I've seen this at many employers around here haven't done that. So we have to use a Form 5329 and basically indicate it's a code 06. Code 7 would be a distribution only from an IRA. So this does not apply to 401ks, so only an IRA. Again, we'd be able to take a look and see if that check box is indicated on line 7 of the 1099-R, then these two exceptions can be used. Would be for health insurance for unemployed individuals. So if they're paying for their own health insurance and they're using money out of their retirement account to do that, if they pulled it out of an IRA, that's fine. Part of the technique is we generally get these people after it's already happened. A good planning technique is to say, take that 401k, roll it into your own IRA, then you can start taking these monies out for these purposes. But if it came directly out of the 401k, we cannot use that penalty exception. So that applies for code 7. It also applies for code 8, which is taking money out for qualified higher education expenses. So that includes tuition, that includes fees, books, supplies, and reasonable room and board. So if we think about the college credits that we had, it doesn't allow for room and board, but the exception of the penalty here does. And this applies to children, also applies to grandchildren as well. So if you're pulling money out and there's a reason why that we may be able to avoid the penalty, this might be one of our more popular ones to use. The last one I just want to talk about is a code 09, which is an IRA distribution. Again, it cannot come out of the 401k, but for use of purchasing, constructing, or significantly improving a property, kind of first home, up to $10,000. So up to $10,000 may be excluded, but if you took $15,000 out, $10,000 could be excluded from penalty, and then the other $5,000 would still be subject to 5% or the 10% on the $5,000. Again, those last three only apply to IRA distributions. Now, when we talk about kind of these early withdrawals, kind of give you some tips of how to handle that. The question may come up. We want to make sure that people are paying the appropriate amount of tax and they're taking advantage of every opportunity to avoid paying penalties when they don't need to. But the question always arises, how much information do we provide when you see a code 1 and start asking, oh, do you have any exceptions to the penalty that we should be aware of? And they said, well, why don't you tell me more about the exceptions? Maybe I can fit into one of these here. And we start going through the 5329 and giving them all the codes, and they say, hey, that one sounds good. Can we use that one? Well, hopefully they know whether they made a contribution to a qualified education program or not. If it doesn't have to be directly tied in, so it doesn't have to be that they used $5,000 directly from the IRA to go from that payment directly to the college. It can be a non-simultaneous times. But we just want to be cautious. We're not kind of walking the taxpayer into a situation where they're going to find an excuse or an exemption code that doesn't apply. So there may be some other things that would be indication of using those funds. For example, if they paid for college expenses, they might have a 1098-T or a bursar statement showing that they made payments on account, or that they may be wearing a sweatshirt or a shirt. Let's say proud grandma of a Millersville student or something along those lines. Then it's probably more realistic. If they say I live in an apartment, but I want to take that first home buyer exemption, probably not going to work, right? If their current address and the address for all last year has an apartment number on it, it probably is not going to work. So we just want to caution that we don't walk them into the 5329 exemptions and get them all excited that we can waive these penalties magically. We don't have any real magic powers here at VITA. We're just going to go ahead and utilize the forms and the instructions that come with them. Now, we do want to make you aware that these are available, but maybe one of the questions we can always say is, so I see that you have some money taken out of an account on an early basis. Was there any special purpose for taking these funds out? They may offer to say, oh, I wanted to pay off some credit cards, or I wanted to pay off my car, or there was a nice TV on sale that I had to have. Generally, those are going to indicate we don't have any exceptions to the penalty. If they said, well, I was unemployed for a time and I had to go ahead and pay my health insurance, I'm going to say, oh, okay, well, maybe we can get you into one of these options. Let me ask a few additional questions. So I think it's just kind of a practice that we want to make sure that we can alleviate any penalties that arise, but we don't want to help walk them into a situation that they may not otherwise qualify for. Again, it's kind of a little kind of interesting approach of how we walk through that process. So again, use your own discretion of going through. But again, remember, all the information that you get from the client should be coming from the client, not us telling them what to say. I think we may have heard of situations where people have gone to tax preparers and someone says, how much are your charitable contributions? And you see this thing, the hand raising from the accountant on the other side saying, we need a little bit more to drop that tax balance down, right? We don't need to do that within VITA. So that's not our process. Okay, a couple other things we just want to mention about the 1099s. Typically, we may see some insurance contracts. I think we're seeing a few more of these where you may get a code 6 or a code W in a 1099R. A code 6 is basically a tax-free exchange of a life insurance, annuity, or long-term care contract. It's basically under a special code section 1035, which means it's typically not going to be taxable for federal purposes. It's technically not taxable for PA purposes, but the caution we have is that we've had some pushback on the PA 1000 and the Schedule SP, that they want those amounts included in the income calculation. So this is basically that you're exchanging annuity or long-term care contract. Let's say that you've changed your providers and someone said, hey, I can get you a better annuity than what you have. We can do a tax-free exchange. That's entirely valid. It's no federal tax, no Pennsylvania tax, but just want to caution that may be impacting some of the other PA issues we have, especially the SP and the rent rebate claim. Another one we may see is a code W. This is oftentimes where people are actually purchasing long-term care contracts with money coming out of their other plans. So if you have an annuity or you have a qualified plan with a broker and they say, I can buy a long-term care policy for you, but I'm just going to use the funds out of your current contract, they're going to issue a 1099R with a code W. Again, that's not going to be taxable for federal purposes, not taxable for PA, not taxable for local. And as far as we know, we haven't had that issue on the PA 1000 or the PA SP yet. So I'm not quite sure how many we'll see here coming out of VITA, people buying their long-term care with their retirement accounts, but it is a possibility. And then just finally, just want to kind of give you a couple resources here as we go through the 1099Rs. Now, probably the majorities are going to be relatively straightforward 1099Rs. Hopefully the box 1 is going to be the same amount as taxable income in a code 7, and everyone's happy with the result that it won't impact federal other than just taxable income that they've already accounted for. It won't impact local or Pennsylvania because it doesn't tax retirement distributions. The unfortunate one, we sometimes have those code 1s, which is not only a federal income tax, a federal penalty, but potentially a PA and local issue. But in case you have any questions, we have some additional resources. And again, these publications are fairly They're quite lengthy, but you can actually get to the specific issue pretty nicely. So they have a nice little index and guide of how to get to your specific situation. Again, if they're relatively unique 1099-Rs, there's no problem with us saying, we need to take a look at this a little bit further, or we need more information from you. And generally, we need more information because they're paying a lot more tax than what they thought they were. So my philosophy is I'd rather take a little bit more time, do a little bit more research, and make sure that we're having them pay the appropriate amount rather than just saying we don't know what to do with it. If you have any questions, you can certainly run those by your site coordinator during the season, which may sometimes get pushed up to Steve and Michelle, which may get pushed up to me. So we'll see the unique ones at some point in time throughout tax season. But we wanted to use this opportunity to kind of give you an overview of the 1099-Rs. Basically, again, let you know the majority should hopefully be relatively straightforward, but what do you do with these unique situations? And we did, like I mentioned, go ahead and put together kind of a frequently asked question list here for you of some things that we've had in the past, just to make sure that we can answer some of those in advance. Sort of the whole thing, as we just kind of talked about, best way to ask the client about how much is taxable to PA and local, how to ask them, again, with the cost recovery. I suggest going back and taking a look at the W-2s. If they're only a couple years, it's probably your best indication of how much their investment is. They can always go back and ask their HR person, who may not know, or their third-party administrator, who may not know, but they have to come up with a number for that they feel comfortable reporting as an accurate amount on the return. They'll be the one that has to supply the information to the state if it's questioned. A couple things that we see, again, the code 2, much like code 1, that will be taxable to Pennsylvania and local. Again, we'll use cost recovery method. Simplified method, again, that would be in the first distribution when the annuitant has retired and there's an investment in contract, again, indicated with a 9B entry on the 1099-R. We kind of talked a little bit about difference between IRA and pension. The pension and annuities are effectively kind of your employer-sponsored type plans, your 401k, 403b, 457 or other type retirement annuities. IRAs, the SEPs and Simples, are generally a little bit more employee-controlled. Government pension says annuity on the form. They will say annuity. Under the government rules, they are actually an annuitized contract. But that doesn't mean that they're going to be taxable for PA. PA is only going to tax an annuity if there is a code D. So if it's a 1D, 2D, 3D, 4D, 7D, or an F, we should have thrown that in there too, are the ones that are going to be taxable for Pennsylvania purposes as interest income. So it's a non-retirement annuity. So not all annuities are considered taxable for PA. It's only a non-retirement annuity. And again, that will be indicated with a code D on the 1099-R. What do we do with a lump sum distribution? The last two options we have here are generally kind of what we normally would work with. If you get a lump sum, you have a choice of rolling it over into another account. Again, unfortunately, we typically see clients well after they've already done the transaction, so they don't even have 60 days from the time that they've taken the funds out before they've seen us. So it may be option number 3 that we have to report the entire amount as ordinary income in the year of distribution. However, there may be a 10-year option, again, similar to the simplified method. If they get a lump sum and they meet the other qualifications, we may be able to use the form 4972 to go ahead and do a calculation. So again, I think that's hopefully a relatively rare context, but generally it may be that someone said, hey, I took all this money out of my retirement account, and guess what it did to me? It increased how much I pay for Social Security because now my AGI is higher. It's impacting, depending if they're not at Social Security eligibility, but they're retired and said, oh, I was on the marketplace, and now all of a sudden, now I have to pay back all this money to the marketplace because I took credits. Well, yes, they do, because your income changed. So there may be some options we can take a look at. I think this is one of the areas where we have some planning opportunities. It's a whole lot easier if they come to us before they do it. But under the VITA context, we generally don't get to talk to them until they already have done the transaction. But there may be some opportunities we have. So again, what we always say, if there is situations that appear a bit unique, we're happy to go ahead and take some time to make sure we're doing the right things for them. There may be some solutions we have that we can't actually do within VITA, but we may be able to direct them to other resources. Hopefully not to me, because I hate doing the calculations of this, how much is taxable, not taxable, but we can give them other resources to help out with that situation. Okay, so we have some frequently asked questions. We have some additional resources here. Again, the publications are relatively straightforward, a bit lengthy, but have some great examples. And do we have any other questions from the audience here, Steve?